Hello, everyone. It's been a while since I've made a video. I just got done moving halfway across the country from Chicago to Western North Carolina, so I honestly haven't had as much time as I've wanted to the last couple weeks. But I've been itching to start making commentaries again and just talking about stocks and investing. And one of my favorite retail investors, Emir, he's doing like a July series where I think he's doing like a video every day, and he's one of the recent ones he did was a retail stock tier list, which I thought was awesome. Um, so I want to react to his hims and hers, like his really basic Excel evaluation of hims and hers, and then I want to do a breakdown of hims and hers on my own and try to convince maybe not convince but give a different perspective on hims and hers, and maybe even convince Emir that it's worth higher than a B tier listing, as you'll see here in a second. um, so let's first react to Emir and see what he has to say about the stock.
At that early stage. So you have to go further out in your forecasting, which of course introduces more risk, but you get it. Next one, another retail favorite. So I'm just shooting myself in the foot over and over. Hims and hers. Him stock actually appears to be undervalued. Now, the problem with Hims is they have really positive historical revenue growth and will likely have that for a few coming periods at least before it normalizes according to analyst forecasting. So I've given them 20%, which means they're doing 1.5 billion in 2024. I've given them 9.1 over that forecasting period. So 20% might seem very low in relation to 70%, but keep in mind that is compounded over a 10-year period. So that's always important to keep in mind. I've given them 15% free cash flow to the firm margins, basically in line with what they did 2024. That is also likely to be increasing over time. I mean, not much debt. They have cash and short-term investments of many times their debt. The only problem here, which can mess up HIMS if you're bullish HIMS, is the dilution rate. So as you can see, I've been trailing the dilution for this one. They did 13.4% dilution year over year from 2023 to 2024. I've assumed 9, 7, 5, 5, 4, 3, and then 3. But what if they need to raise capital more than that? Or what if they need to compensate their employees even more aggressively? So let's do something like 8, 8, 8, 7, 7, 7, and then 5, 5. Then you get a stock that is slightly overvalued, but yeah, still. When it comes to dilution rate, you really just have to look at the outstanding stock-based compensation expenses and try to make some assumptions based on that. But based on what we're looking at here, HIMS appears to be undervalued according to these assumptions here. Would I like to own HIMS? I don't know too much about this business. I understand it is healthcare. They have different kind of pills and stuff like that. I understand that they also recently had some drama with Novo Nordisk, and it's a pretty volatile stock. But I mean, just from an intrinsic valuation perspective, I can't speak much to the quality of the business, but it seems to have a huge following. Would I like to own it in the tier list? I would put it at a B tier. I mean, it is not a sector that I'm overly enthusiastic about myself. They do seem to have some pretty interesting growth ahead of them. They seem to be able to throw off and generate a lot of cash. But I don't really know about the competitive advantages, especially now with the dawn of AI and new drug discovery and stuff like that. I mean, I think this industry as a whole is kind of shaky. the coming years. And there is some drama around the stock, but I mean, based on the intrinsic valuation exercise, now keep in mind it is not a valuation, but according to those assumptions, I mean, not the worst stock to hold. Roughly, I would say I will probably want to own AMD over HIMS. So B tier, not good, not bad. I mean, it's there. I mean, it's fine. That's what I would say about HIMS. Next up,
Okay, so before I go into my spiel about hymns, I want to say I think there's a lot to learn from the way Emir does his Excel evaluations with free cash flow. I think a lot of retail investors could learn from him. And I definitely have. I'm not as maybe in the spreadsheets as he is. I'm more of a qualitative investor that does do a good bit of my own math on like financials, but I'm more of like a directional financial guy. So like as long as I see directionally the financials are good and the balance sheet is really good, then that's usually good enough for me. Um, I don't try to get too fancy with it. But anyways, here's what I've got for you guys and kind of what I want to cover for Amir just to get him up to speed as well. So, Hims and Hers, a modern day tale of David versus Goliath, which is, I mean, if you really think about it, that's what it is. Hims is going up against Legacy Pharma. You can see some of the drama with Novo Nordisk happening in real time recently. Eli Lilly is not happy with them either, and the other compounders. There is a big, I would say, a big battle going on um, between the incumbents and these new telehealth companies that are popping up doing compounding and various things that are really disrupting how Legacy Pharma does business with pharmacy benefit managers, which basically rip off Americans and all this other stuff. So that's a whole nother story for another time. But I wanted to go into sort of like some really key catalysts for Hims and Hers over like for the rest of 2025 as well as just over the coming years till 2030. A lot of this stuff is more qualitative. They recently acquired a California-based peptide facility. To me, this is the most important long-term catalyst for the company because um, healthcare is going through this change right now because not only is there like a lack of trust between the pharma institutions, the health institutions, and the citizens in America. They also the citizens, Americans want something different. They want a more proactive, preventive approach that delivers better outcomes instead of just kind of masking the problem with medications and potentially causing more chronic disease and long term issues. And in another video, I talk about this in depth, and Andrew Dudum, the CEO's story with his dad, who, I think his dad, Dr. Hyman at Cleveland Clinic, saved his life. And I imagine there's some connection there where Andrew wants to use Hims and Hers as a platform that helps people prevent these chronic conditions using therapies like peptides that are just long chain amino acids. So that's I think this peptide acquisition is extremely important because it long term this turns Hims into what you could call as the Don't Die company. I think if you've heard of Brian Johnson's Don't Die movement, where it's like, oh well, we want to live forever, or we want to live longer, we want to sleep better, do all these different things to try and extend our life beyond what it normally is, which is maybe 76 to 80 years old. Well, I think Hims is positioned to take advantage of that with their platform, the data they have on their customers, their personalization, and obviously their peptide facility where they'll be able to make different peptide therapies at scale at a cheaper cost than what you can get them for right now. So that kind of ties into the next point about how Hims is a deflationary healthcare company. They bypass the middleman, and they're really just trying to deliver straight to the customer at a cheaper cost while delivering that better outcome I talked about earlier. They're also expanding internationally. So they just acquired Zava, which is a UK based, it's basically like a UK version of Hims. Zava has 1.3 million subscribers, so they're adding that on top of the 2.4 million they already have here in the US. And it remains to be seen, the exact financials of Zava and kind of what they're getting into there. But based on Hims's ability to monetize their subscriber base in the US, I imagine they can do something similar internationally, and that Zava will allow them to do that uh, in the near term in the UK, France, and Germany, I believe. They also hired one of a veteran Amazon executive as their CEO, COO, which is fantastic news. He's going to help them develop their international business. There's massive Hers platform growth, which is the women's side. That's Hims and Hers. They have a menopause offering that will be dropping by the end of 2025. And they also recently released a new green apple gummy product for women that supports healthy hair growth, which is surprisingly, that's like a big thing for some women. I talked to my girlfriend, sister, my mom, and that's a really big deal for a lot of women. So I think that could do really well for them as well as these menopause and other Hers products that'll be dropping. Hims, the on the men's side, they have a testosterone offering that's going to be dropping by the end of 2025. They've kind of already dropped some of the testosterone, like 2-in-1 and 5-in-1 products, but I think you're going to continue to see more personalized testosterone products as the year goes on. They also just acquired a New Jersey based at home testing facility. That's going to be a comprehensive testing facility. They're going to check for over 100 biomarkers with these at home tests. And you can kind of think about that if you're familiar with Function Health. Function Health was actually founded by Dr. Mark Hyman, who's the same guy who saved Andrew Dudum's dad, saved his dad's life when he was younger. So there's a connection there. And a lot of the Hims retail investor base has kind of noticed over the last few months that Function Health, the way they do business, could be something that Hims might want to do. And this is a direct competitor to that, 100%. I use Function Health. It's $4.99 a year, I believe. Um, Gross margins are somewhere in the 50 to 70 range. It's not 100% sure since I'm not 100% sure on that since Function Health is a private company. But if you look at Quest Diagnostics, you could see kind of like what the costs are there. I think it's somewhere in the 100 to 150 range for like a test. So if you do 400 or $500 minus 100, 150, you're right in that $60, 60% gross margin range. And since Hims is, vertically integrating this comprehensive testing facility, I think over the long run, you're going to see, you might be able to see them have like quite a bit of operating leverage there with their integrated testing facility. Maybe that'll boost it up even to SaaS like margins. They also just hired Robinhood's VP of product. She is now their chief product officer, which that's huge to me. A lot of people compare Hims as like the Netflix or Amazon of healthcare, and I think that's pretty good. That's a pretty good analogy, maybe. But to me, I actually think Hims is more comparable to Robinhood in the same way that Robinhood democratized investing to retail investors and is making and they're kind of touching every part of your they want to touch every part of your financial life. Hims is going to do the same with healthcare. They're really going to democratize peptides and all these different health treatments and just the ability to take control of your health to everyone at a much cheaper cost than you can get it via insurance and through your primary care. So I think, and I also just to add to that, the culture at Hims is very fast. If you pay attention to this company quarter over quarter, you can tell they just continue to execute. They're always dropping new products. They're always doing new deals, getting new acquisitions. And it really reminds me of what Vlad and the Robinhood team have been doing. They just continuously execute. They're moving at light speed, and that in and of itself is part of their moat. So I really like that hire for them. They're also expanding into Canada. Novo Nordisk actually failed to repatent their semaglutide, which I believe is one of the reasons the CEO was fired. We're just kind of finding out about that now. So as of January 1st, 2026, Hims can and will sell generic compounded semaglutide in Canada. They dropped that news. So that'll be another revenue driver for them. It remains to be seen how big that will be, but it'll definitely be something. Um, yeah. They also hired a former GM exec as their chief technology officer. He has over 2 decades of experience in data and AI at both GM and he worked at Amazon as well. So he's going to help build their AI healthcare platform. And I think this is going to be really important because Hims has this huge subscriber base that continues to grow. They have a lot of personalized data that's going to help them not only build products for their customers, but it's going to help their doctors as well as their AI platform prescribe better therapies and deliver better outcomes to their customers. So I think it's going to be really important that they have this this internal AI platform that helps them speed up the delivery, like even more so, speed up the delivery of their products to customers and, really just help them personalize products even more. So I'm looking forward to seeing that over the coming years. And they also recently did a 0% interest, $1 billion senior convertible note offering. It was heavily oversubscribed. So, and I believe they used some of that convertible note offering to buy Zava. We'll find out soon what they purchased Zava for, which I imagine we'll find out in the Q2 earnings call coming up. But we'll see. Numbers wise, they're guiding for 60% year-over-year revenue growth in 2025. So for Emir's video, that's one correction I would make is you could change, I think 20% revenue growth CAGR for 2026 and beyond, I think is reasonable, but you should change 2025 to 60%. That's the middle range they gave. So approximately 2.35, 2.36 billion for the year. And I imagine they hit that. They typically outperform. That remains to be seen if they'll hit that. Obviously, there's some other things that could happen, but I believe they'll either hit or exceed their expectations there. Revenue growth for trailing 12 months was actually it's 85%, which is ridiculous. They've been continuously overperforming their guidance. Q1, they did 100%, 110% year-over-year revenue growth, which is just ridiculous in my opinion. We love it, but it's ridiculous. So you see, I don't think they can continue that forever, but I also I'm not going to underrate Andrew and the team. They just continuously outperform and find new opportunities to deliver to their shareholders. Probably the most impressive like financial stat is their year-over-year free cash flow growth from 2023 to 2024. They grew 321%. I believe it was 47 million free cash flow 2023 to 198 million. So that's pretty crazy. And I also have some more numbers for you, Emir. So this is really just directionally how I do my financials. I don't have a fancy spreadsheet that I use really. I do have a spreadsheet that does some calculations, but I really like to just do directional math, really basic stuff. So if we assume they do 2.36 billion in 2025, these revenue numbers are for 30% CAGR. So a little more bullish. So let's do 30%. We're looking at approximately 8.77 billion in 2030. I think it's hard to predict out more than that personally. Like it's like kind of crazy. Now Hims actually guided for 6.5 billion in 2030. That's what they recently guided for. The last time they guided for a revenue number 4 or 5 years in advance, this is what happened. So they guided for, I believe it was 1.2 billion in 2025, if I'm not mistaken. Yeah, I think it was 1.25 billion. In 2021, they got it for 1.2 billion in revenue. And then they hit 1.47 billion in 2024. So they did it 1 year early, and in 2025, it looks like they may double their guidance that they originally had. Now, I'm not saying they're going to do that, but I'm saying they have a history of outperforming. They have a history of under promising and over delivering for their customers as well as their shareholders. So, my revenue guidance here, I wouldn't say it's super conservative. I wouldn't say it's super bullish. I wouldn't say it's super bearish either. It's kind of in the middle. Like this is revenue wise, I think this is probably like a base case for me. But I also have my bear base and bull case for net margins and free cash flow margins based on these revenue numbers. So the bear case, these would be if they just maintain their current net and free cash flow margins. This is what I have them doing. So if they do 8.7 billion in revenue in 2030 at 8.5% net margin and 13.4% free cash flow margin, we're looking at basically 6x from 2024 net income and free cash flow. That's the bear case based on this. Now you could, I'll run something even more bearish after this for you. But let's look at the base case. So if they do, let's say they bump up somewhere in the middle to 14.2% net margin and 20% free cash flow margin, we're looking at 10x net income and almost 9x free cash flow by 2030. Now, if we do the bull case, 20% net margin and 25% free cash flow margin, I actually still think that's pretty conservative for a company that is not optimizing for free cash flow or profitability at the moment. They're just trying to grow the business as much as possible. So I think, Palantir has 30% net 30% free cash flow margin. I think Nvidia has close to 40. I'm not saying Hims is on that level, but it's possible. Like I don't, maybe that would probably be the Super Bowl case. Anyways, so 20% net margin, 25% free cash flow margin. You're looking at a 14x net income and 11x free cash flow for 2030. Those numbers don't look crazy to me, but who knows? Maybe I'm completely wrong. But let's do something even less. So I have 6.75 billion in revenue for 2029, but let's assume this is 2030 instead. Let's say they just barely hit there. 2030 guidance. They guide for 6.5 billion in 2030 and they barely hit it. They hit 6.75. So we use the same net and free cash flow margins from the previous example. We're still going almost 5x net income in free cash flow in the bear case. We're going 7.5 and almost 7x in the base case. And we're going 10x, almost 11x, and almost 9x in the bull case. If we just move revenue down to like what they're guiding for. So to me, like again, these are very conservative. Like I have, in my opinion, like this is not like I have some other calculations that I've made that I think will actually happen, and I could be crazy, but these numbers are very very conservative because I think really it doesn't matter. The numbers don't matter that much in terms of like being exact with investing. What matters is just being like directionally right and testing like all these different theories where you're like, okay, well, is this like what's like the worst case scenario? Well, okay, the worst case scenario, it still goes, they're still increasing their cash and profitability by a lot. And this isn't the worst case scenario, but even the worst case scenario is still way better than what they're currently doing, in my opinion. So I thought I'd share that. I wanted to, you know, go through what I think the company is doing and give a really deep insight into those things and also provide some financial analysis that is more directional than it is exact. I think it's really hard to be exact with this kind of stuff, but it's good to think about it a little bit. So, really curious what the HEMS community thinks HIMS and Andrew and the team can do for net and free cash flow margins over the next 5 years by 2030. And I'm also curious if Emir has a different opinion on hims and hers after, well, maybe he won't watch this video, but if you do watch this video here, I'm curious if your opinion has changed on hims. Would it move up to the A tier? Would you think about investing in it? What are your thoughts? Just knowing all these different catalysts and like kind of going in depth on it. So, anyways, thank you for watching and have a great upcoming week.